Hey, what's going on, everyone? Welcome back to the channel all about real estate. My name is Lewis, and in today's video, we're going to share some really interesting information about mortgage interest rates, where they have risen to, how that impacts your purchasing power. We're also going to go over some interesting data here in the market, and I might even jump into some specifics about Rocklin and Roseville area here in the Northern California market. So if you stick with me, we got some great information to share. If you're new to the channel and you like all things finance, real estate, and investing, consider liking and subscribing, and let's get right to it. All right, so the first thing I wanted to talk about is where mortgage rates have risen to. Now, many of you may be aware that the 30-year fixed rate mortgages have gone up. I think as a whole, we expected mortgage rates to rise this year. We just never expected they would rise so quickly. In fact, I remember doing a video maybe a few months back, and some expert forecasters were saying that by the end of 2022, we'd probably see the 30-year fixed rate mortgage around 3.75%. Well, we've pretty much blown through the threes. We've gotten mostly through the fours, and the average 30-year fixed rate mortgage with excellent credit is sitting right about 5% as of today. Now, this is with no points, meaning there's no additional cost to secure that rate, and there's no credit. So, and then if you shop around a little bit, you might still be able to get into the upper fours with no points, no fees, no lender charges, things like that. Just depends on where you go. But with that said, this is a pretty dramatic increase from where we were previously, obviously. Now, I do want to go ahead and give you some perspective as to how this impacts purchasing power and monthly payment. So I did a quick Google search for mortgage calculator. Let's go ahead and take a loan amount of $400,000. And I realize that's probably not going to be that way in every market. In fact, in California, in my area, we're probably seeing the average loan amount closer to 5, but let's just stick with that. Let's take the average interest rate at 5%. That would put your principal and interest payment at $21.47. Okay, so that's kind of where we are hovering today. But let's just take a look at where we were 3 months ago, with average rates at around 3%. So we kick that down to 3%, and the payment would actually be about $16.86. So that is roughly about $500 difference in the monthly payment. So that's actually certainly compressing the affordability on some of these houses and making it harder for like the first-time home buyer to get involved in the market, because we have not seen any actual reductions in pricing at this point. In fact, the market is heated up so much that we're seeing still multiple offers. We're seeing people go well above the list price, and it is making it more and more challenging to get involved in this market. Which actually brings me to the next thing that I wanted to share with you. I pulled up some information from the Sacramento Appraisal blog, and it actually showed that the investor activity is upwards of about 1/3 of the market. So in other words, investors are purchasing or driving approximately 33% of all sales activity nationwide for U.S. new and existing home transactions. Now in the Sacramento market specifically, Redfin states that investors make up about 19.4% of the market. So in other words, 1 in 5 transactions are actually investor driven. But it says, keep in mind, 15% of sales in the region are all cash, which reminds us that investors don't always use cash. So we have, what I'm seeing here more recently is that some of these investors, as well as even people who are buying their primary homes, they are offering cash with ridiculously competitive terms. Makes it very hard for a first-time home buyer to compete if they're only, say, putting 3.5% or 5% down to purchase their first home. And in many cases, they're waiving a lot of their contingencies and things like they are waiving inspection contingencies. They're just buying as is. They're waiving their appraisal contingencies, which means if the property appraises less, they're just going to cover the difference. And in some cases, if it's all cash, they don't even have a loan contingency. With mortgage rates going up, we've seen refinance activity fall off a cliff. I think mortgage applications for refinance are down like 75% year over year. We've seen purchase applications being reduced. But one thing that I think is really interesting is that several lenders out there are getting very, very competitive. One thing they are doing is they are reducing the margin on their loans in an effort to reduce the interest rates to keep the mortgage volume and activity going. And because of the reduction in some of these mortgage applications, I have actually started to see that in the news there has been mortgage companies that have started to do layoffs or close certain locations and things like that. So there is certainly a shift in the market taking place at this point. And then the last point I want to touch on with regards to mortgage is that even with the rates going up, there can still be a great demand as criteria expands. One of the things I am seeing here is that some new loan products are starting to hit the market. They call them non-QM or non-qualified mortgage. So it's not your typical Fannie or Freddie backed loan. However, they are expanding the guidelines for those that were underserved previously. An example of that would be somebody who's self-employed. They've opened up options for bank statement loans, as well as investors who are purchasing in this market. They have something called a debt coverage service ratio loan, where if you put a certain amount down and the proposed rents cover the principal, interest, taxes, and insurance on a property, and you have good credit, they can lend on those properties, expanding the guidelines without having you to without needing you to show personal income. So some of those things are shifting a little bit, which is expanding the criteria, allowing investors to come in and probably increase that activity slightly, despite the higher interest rates. So I think we may still see a little bit more of that. But when you look at the numbers, it does become very hard to cash flow in this market with putting a smaller down payment. You know, in many cases on like a single family residence, let's say just out in Rocklin Roseville, you may need 30-40% down in order to break even or cash flow on a property as a rental. So I'm not sure if they are sort of building in or speculating or anticipating future rate hikes here in the future for the rental rates, that is, but it's just interesting to start seeing some of this unfold. I think you should be very cautious in this type of environment. Make sure that you're looking at a long time horizon versus speculating in the short term. Make sure that you have a really good financial runway. That way, in case we do kind of fall on hard times, you can weather the storm with an emergency fund or something like that. So, okay, now with that said, I want to switch gears slightly and just show you what I'm seeing here in the Rocklin and Roseville area. So things are certainly picking up a little bit. I have each and every Rocklin and Roseville zip. The charts up on the screen represent that. Now, this is the data for the end of February. The data for March isn't going to be out till next month, but I think the data is going to show that it's heated up even more in this market. So the light green bar indicates the number of homes for sale. Only have 107 units across those two cities. The dark green bar is the number of closed sales, 178 for the month of February there. And if you go back to February of last year, that sales activity is actually down slightly. Now, this red line indicates the number of homes under contract. That is up on the rise, so we're sitting about 244 units under contract. Most of those will likely close in the month of March, but I do think sales activity and inventory is going to kick up moving into the month of March. Now, let's take a look at the average price per square foot. This is what I think is really interesting right now. So for the month of February, the price per square foot actually jumped to $339 on average. The month prior was only $324. So what is that? Nearly a $15 swing in the price per square foot. It means that the price of these homes are really starting to increase. We're not seeing the softening that we thought we might if interest rates go up a little bit. Now, only time will tell. We're going to have to see how this next couple months unfold, but just really interesting data point there. If we go to the average days on market, we're only sitting on market for about 2 weeks. Very aggressive seller's market. Homes are flying really fast, just still very low supply. No real surprise there. We have this green line indicates the sales price versus the original list price. This is really interesting. On average, homes sold for about 103% of the original list price. So homes are still selling for over what they are listed for. This chart right here is the sold price, average sold price versus the average for sale price. Stayed relatively stable. We've seen an uptrend. Average sold price is $701,000 between Rocklin and Roseville. And then if we go to the month's worth of inventory, we're actually rolling over slightly here. This is not the best sign ever. I'm hoping we're going to see more inventory come into March and April. And May, of course, but we're sitting at about a half month's worth of inventory, so very low, very competitive. All right, so that's the info and data that I wanted to share here in this video. We're starting to see some interesting trends. Anyway, hope you found the information useful. Thank you so much for taking the time to watch. Have a great day.